Chapter 3, Problem 1 says that we have a borrower that's going to make a deposit into the bank in a savings account that earns 6% per year. And they're going to get annual compounding, and we want to know how much they're going to have at the end of 7 years. So it's pretty straightforward. We've got 7 years, so our period is 7. 6 is our interest rate. We've got a $12,000 deposit, and that makes this a negative $12,000 because if it's a deposit, it means cash out of pocket, and so the positive negative sign always follows the cash flow in and out of your pocket. In this case, it says nothing about any additional deposits or withdrawals, and then they want to know what we're going to have at the end of 7 years. So if we punch that into our calculator, we will have 7 is our N, we have 6 is our I, $12,000 negative is our present value, and then 0 in cash flows, and then solving for future value, we would get $18,043.56. Now, assuming part B says, assuming that the account paid 9% and compounded quarterly, I want this savings account, that's for sure. Then how much would they have at the end of 7 years? In this case, because it is quarterly compounding, that means we're going to have to multiply the number of periods by 4 periods per year. So in this case, times 4, we're going to have 28 periods. We also have to divide the annual interest rate by 4 to find out what the quarterly interest rate is. So 9 divided by 4, which is 2.25. We still have $12,000 as our deposit, no payments and cash flows. So we get $22,575. Part C says, in comparing the two, what are the respective effective annual yields? Now, effective annual yield, or IRR, or just yield, is what the actual annual rate of return was when you account for compounding. Now, in the case of annual compounding, there is no compounding of interest on interest throughout the year, so the effective annual yield is just 6%. Anytime you have annual compounding, the effective yield, or the IRR, is the same as the annual nominal interest rate. Now, in the case of this second scenario where we have 9% interest and 4 periods per year, then what we would do is we could just take this same number here where we have a $12,000 deposit and we have a return of $22,575, and go back and say, okay, what was our annual yield on that since we had it for 7 years? And then we would solve. So punching these in the calculator, we get an effective rate of 9.31%. And the quarterly compounding gives us that extra 0.31. The easiest way to look at any sort of effective rate, comparing it to the nominal rate being the stated interest rate, is to just do it 1 year at a time. And so let's do that same problem, and we'll just do it with a $100 deposit. Okay, so let's say that we have quarterly compounding and we have a 9% interest rate, but it's quarterly, so we divide it by 4, and we had a deposit of $100. At the end of that, we would have $109.31. So that means we made $9.31 of interest. Now, if you go back and you look at that same number and 109.31, and you just did it with 1 period, so change your number of periods to 1, and if you had a $100 deposit and you made $109.31 out, you would get an effective annual rate of 9.31%. The next question says, if you're going to make an investment, let's say $25,000, would you rather earn 6% compounded monthly or 7% compounded annually? So just offhand, 7% is always going to be better than 6%. But let's figure out how we would determine that if, say, it was a little bit closer. And once again, we'll use the example of a $100 investment. And we were going to get 6% compounded monthly. So that would be 6, but it's monthly compounding. So we have to divide it by 12. So it's going to be half a point per month. That would mean we would have 12 periods per year. So we would have 106, 17. On $100, that's obviously 6.17% yield, which is still not going to be anywhere close to a 7% yield. We don't need to know what the effective rate is for anything with annual compounding. It's just the stated or nominal rate. So that would be 7%. So we would always want to have the 7%. Now let's use the $25,000 investment that's asked for in the problem. So if we had 12 periods, 6% compounded monthly, and we had a $25,000 investment, no intermediate cash flow, $26,542. We would make $1,542 off of that investment. If we had a $25,000 investment that paid 7% per year, but it's compounded annually, that means we just have one compounding period, then we would earn $26,750. This one's pretty easy and very straightforward. It has an investor saving $5,000 twice a year for 12 years, and they're earning an interest rate of 8% compounded semi-annually. Semi-annually would mean twice a year. So over 12 years, that's 24 periods, and it's 8% per year, but it's semi-annual. So we're going to divide it by 2. So it would be 4% every 6 months. There's no mention of any initial deposit, so we're starting out with a zero balance. They're going to put in $5,000, and then at the end of the 24 months, if we put that into our calculator, we're going to get $195,413. Now, this question is a little bit tricky because deposits are made at the beginning of every period, and it doesn't necessarily say that interest is paid at the beginning of the period. It says it's paid at the end. But what happens is we have 24 periods, 1, etc., all the way to 24. But if the deposits are made at the beginning of the period, what the book is implying is that there is another deposit made at date 0. So in this case, the way that they are asking you to solve it, and you're not going to really run into this in real life, but if it's part of your homework, you're going to want it. So what you're going to do is you're going to change this, your N, to 25, because you have what they're saying is an extra deposit. So that means we have a 25th deposit, and still 8% per year, compounded semi-annually, so it's going to be 4%. And in this case, it still says no present value because we're counting that payment happening at day 1 anyway. So it's still negative $5,000. And then you get a final value of $208,230. If you get assigned this question, you might pose to the instructor, how often are you going to run into this and where does it happen? There might be some debate about like ordinary annuities versus annuities due. That's a little different type of finance, but nonetheless, that's question 3. Okay, question 4 says, imagine you are putting $1,250 into an account, and this account's great. You're earning 10% per year. It's probably your buddy's hard money lending fund. Anyhow, how much are we going to have at the end of 4 years? So it's 4 years, and we have quarterly compounding. That means we're going to have 16 periods. If we're making 10% per year divided by 4, that's going to be 2.5% per quarter. There's no mention of any sort of initial deposit, and we're making cash out of pocket into the account of $1,250 and solving for that. So I'm going to walk you through the steps so you get used to the HP 12C. So if we had 4 years, enter, and then quarterly would be 4 times, it gives us 16. We put that in as our N. And then we have 10% per year, enter, but it's quarterly. So we have 2.5 per quarter. That's our interest rate. 0 is our present value. We're going to have 1,250 deposits. And since our deposits cash out of pocket, we change that to a negative and make that our payment. And then we solve for future value and we get 24,225. All right, so this next question is a little bit tricky, and it can be done on your financial calculator. You can put in variable cash flows for each year, but I don't recommend doing that because one miss of a keystroke can throw off your entire problem and you probably won't know where you went wrong. So anytime you have cash flows that are variable, in other words, your payment, if your payments or your deposits different from one period to another, it's usually a good idea to do that on a spreadsheet because then you can see the whole calculation all at once. But in this case, let's imagine you don't have a spreadsheet in front of you and where you're sitting in front of the exam and you have variable cash flows. The question here is, we've got a 5-year investment and we're going to make deposits over the different years. And so let's say we have 1, 2, 3, 4, 5 years of deposits. And that means at the end of year 1, we are going to have 4 years of compounding left. Okay. So our N would be 4. And we would have, since we have annual compounding, our nominal rate, 15%, is going to be just that. It's going to be 15. And our first deposit is going to be negative 2,500. Negative because it's cash out of pocket. And there are no interim cash flows over that 4 years. And so at the end, we're going to have 43,72,52. The second year, we're going to have 0, but there would be 3 compounding. We're not going to get any interest, 0. So the second one would just be 0. The third deposit, which is at the end of year 3, is only going to compound for 2 more years. So we'll have 2 years there, 15%. That third deposit is only $750. So at the end of 2 years, we're going to have $991.88. Our fourth deposit, which happens at the end of year 4, and therefore is only going to compound 1 time, is also going to make 15%. It's going to be $1,300. Again, negative because it's cash out of pocket. And after 1 year, that will be worth $1,495. And then finally, in the 5th year, we have nothing. So that's 0. So when you have variable deposits like this, it's better to just look at them as separate investments and then just tally up how much money you have at the end. And in this case, if you add it all up, you would have $6,859.40. Again, this is very much a textbook question. It's not really something that you're going to have to figure out in real life, especially not like this, but that's how you solve this problem. Okay, this is the 6th question. Your buddy comes to you and says, hey, I've got an opportunity for you to invest in this real estate deal. It's going to pay you $750 at the end of each month over the next, say, 8 years. But because this is a risky deal, you figure that your rate of return on this should be about 15%. So if you're looking at receiving a series of cash flows over the next 8 years and you want to earn a 15% return, you need to know how much to pay for that deal or how much you should invest in that or what it's going to be worth today. Then we're solving for present value. If we want to know what something's worth today, that's present value. We want to know what it's going to be worth in the future, it's future value. So over the next 8 years, we're going to have monthly compounding. So we're going to have 8 times 12 or 96 periods. And we want to get a 15% annual return. But since it's monthly compounding, we have to divide that by 12, which is going to give us 1.25 as our periodic rate of return. We're solving for present value, but we know that we're going to get $750 per month, every month, for 96 months. And we want to know what it's worth today. There's no mention of any sort of final cash flow. So we want to know what the present value of 96 payments of $750 is, if we need 15% return on that. So punching that into the calculator, we have 8 years and multiply that by 12, we get 96 months. We have 15, and the nice thing about the G key here, we just put G and then we'll divide by 12 or multiply by 12 for us, and it enters it into the proper spot. So I did 15GI, and then 0 for our future value, and we get positive $750 of cash flow for each month. And then solving for present value, we get $41,793. So that's the first part. $41,793 is what we would pay for this investment. The next part is, what's the total amount of cash that we're going to get on this deal? Well, that's pretty easy. It's $750 times 96. And if we multiply that, we get 96 times 750 equals $72,000. The difference between the two, 72,000 minus the 41,793 that we put in, equals 30,207. We put in 41,793. When we get that amount of principal back, the rest is interest that we earned, or in this case, profit. Okay, this is question number 7. Suppose we have a deal that is going to pay us $21.50 annually for 10 years. We want to get 12% return on our investment for the level of risk that we're taking on for this particular investment. If our 10% annual return, if our 12% annual return is compounded annually, what would we be willing to pay for that investment today? So we're obviously solving for present value because we want to know what the value is of the investment today. In this case, we have 10 years because it's annual compounding. We want a 12% return. We don't need to change that because annual compounding is the nominal rate. We're going to get a positive cash flow of $21.50 each year, and no mention of any additional cash flow at the end, so future value would be 0. Solving for that, so we're on 3.7. So in this case, we have a 10-year investment, and it's annual compounding, so we're going to have 10 periods. 12% per year is our rate. That doesn't change again because it's annual compounding. We have $21.50 as our cash flow periodically every year, so that's going to be our payment. It's positive because it's cashed into our pocket. There's no mention of any additional cash flow, so 0 is our future value. Solving for present value, we get $12,148. Now, the next part of this question says, well, what happens if the payments are provided at the beginning of each period? Well, again, this is a tricky question, and this has to get to do again with annuities due. So you're not really going to run into it that often, but effectively just what that means is we want to know how much we're going to pay for the investment today, but the very first payment is going to happen the same day that we make our investment. So there's not going to be any compounding on that. So remember that first payment is going to be the $21.50, and then we're going to get 9 more payments of $21.50, for which we want a 12% return. So punching that into our calculator, we have 9 as our N, 12 as our I, $21.50 as our payment, 0 is our future value, and that gives us $11.45. But then remember, we also have that $21.50, which was not compounded. So we just get that back. So effectively, we're going to pay $13,605.74. Question number 8 says we have an opportunity to invest in a real estate deal that's going to pay us $45,000 at the end of 6 years. We feel like 9% is a good return for this type of investment. And this problem is a little unusual because it's asking us to decide that we want a 9% quarterly compounded return. However, there are no quarterly payments. So it's pretty unusual that you're going to have compounding periods that don't match the cash flows. However, sometimes you will. And a lot of, say, syndicated investments or things like that, they don't pay out every month. They pay out quarterly. In this particular problem, there is no quarterly cash flow, but the investor is deciding that they want a 9% annual return, but they want it compounded quarterly. So here's how that would look. We have a payout that we're expecting of $45,000 at the end of the investment, which means that we're going to get a positive cash flow of $45,000 at the end of 6 years. But we want our return to be quarterly compounded. So it's going to be 6 times 4, which is 24 periods. We want a 9% return annually divided by 4 because it's quarterly. So that's going to be 2.25. There's no mention of any cash flow along the way. So our payment's going to be 0, and we want to know what we should pay for this investment today. So we're solving for present value. We're on problem 3.8. So if we punch this into our calculator, we've got 24 periods is our N, 9 enter, 4 divide to make sure that we don't mess up our math is our interest rate. Our periodic interest rate is 2.25. We know we're going to get a positive cash flow of $45,000 at the end of the investment. There's no mention of any cash flows along the way. And so when we solve for present value, we get $26,381. And $26,381 is negative because that's what we're paying out of pocket for the investment at the beginning. And then we will get positive $45,000 at the end. So in this problem, we're evaluating an investment that's going to pay us a different cash flow at the end of each year. And so the way that we're going to solve this one is we're going to take the present value of each one of those payments, and then we're going to add them all up together. And so our first payment at the end of year one, and we are earning a 12% annual return, so we don't have to change that, is going to pay us a cash flow of $12,500. So we're going to end up solving for the sum of the present values of all of these different cash flows to determine how much this investment is worth to us today. Okay. After year 2, we're going to get a $10,000 return. After year 3, we're going to get a $7,500. After year 4, we're going to get $5,000. After year 5, we're going to get $2,500. And then year 6, we're getting 0. And then year 7, we're going to get $12,500. The point here is to have you practice understanding what the value of different investments is worth today. And so we want to know this is what the investment is going to be and what is it worth today. Then we need to figure out what the present value is of all of these different payments and add them up. And that will be the present value. So in this particular case, if we solve for the first one, we're going to get 11,161. These are all going to be 12%. We're getting 12,500 after 1 year. And if we want to make a 12% return on that, then we would only be willing to invest 11,161. All of these present values are going to just be a simple math summation because they're not discounted. That's the value today. The value today is what it is. So in the case of making $10,000 after 2 years, that would be worth $79.72 to us today. If we were going to get $7,500 after 3 years at a 12% return, that would be worth $53.38 to us today. And then a 4-year deal that pays us $5,000 at the end would be worth $31.78 today. And $2,500 5 years from now would be worth $14.19. 0 is 0. Something that pays us 0 in the future is worth 0 to us today. And then finally, if we are 7 years from now going to get $12,500, we would be willing to pay $56.54 for that one. And so to get all of these future cash flows, and we would be willing to pay for that, if it was all one investment, we would add that up and we would be willing to pay $34,722. Okay. Problem number 10 has an investor that's looking at purchasing some land, and they have the opportunity to purchase this land today, and they know that they're going to 10 years from now get $15,000 for the land. They feel like this investment should pay an 8% annual return compounded annually, and the lot is for sale for $7,000. The investor wants to know, is it worth it? And so there's two ways you can go about looking at this. One, you can say, okay, the lot's for sale for $7,000. I need an 8% return on my investment. I know what it's like. I'm guessing what it's going to be at the end of 10 years. It's going to be $15,000. So let's just put it up on the board here. $15,000 is what the lot will be sold for. So there will be a cash inflow. It's being listed for sale right now for $7,000. It's not going to cash flow anywhere along the way. We'll talk about that in a second. The required rate of return is 8%, but if we buy it for $7,000, we want to know what's our return going to end up being. And if we solve, we're going to get 7.92. So it obviously doesn't hit the 8% return. What is the investment actually worth today? Well, we could do that same calculation. If we think we're going to get $15,000 after 10 years, and we want an 8% return, then the lot's only worth $6,948. Now, this isn't a very realistic example, and it's really just an exercise in showing you that there's multiple ways to use time value of money to make decisions, okay? Now, if you are looking for an 8% return and an investment's going to pay you 7.92%, what's your threshold there? Or another way of looking at it is the present value of this investment at an 8% return is only $52 difference. So it's kind of splitting hairs. The other thing that this problem does not take into account is the fact that there is negative cash flow. Even though you own a lot and it's not paying any money, there's still negative cash flow because you have property taxes. You might also have insurance. You might have other costs associated with owning that lot. So the example is not very realistic, but the point here is that if you have an investment 10 years from now and you think it's going to pay $15,000 or sell for $15,000, that's a pretty precise prediction for something 10 years out, which is very, very hard to do. So in my opinion, the reality of this problem is that it's effectively the same. A $52 difference over 10 years. Again, this shows you that the two different ways to solve this problem is if you already know your required return on investment, in this case 8%, then the value to you is $69.48. Or if you know that the selling price is $7,000 and you want to know what that's going to be that return is going to be, is it going to meet your 8% threshold? Solve for I and you get 7.92. Doesn't quite hit it. So there's multiple ways you can look at that. That's problem number 10. Number 11, we have a company looking at investing in a project for $100,000. And What they're going to do is they're going to invest $100,000 today, and they expect to receive $15,000 every year for the next 10 years. So that would be a periodic payment and $15,000 every year for 10 years. Annual compounding, so we have 10 periods, and then there will be no future value on this investment, so it would be zero. And if the company wants to receive an 8% return on investment, they want to find out what the yield is here. Now, if the company wants an 8% return on investment, we want to know, is this a good investment or not? We just need to know if it's going to beat that 8%. Well, $15,000 cash flow times 10 is $150,000 over 10 years. That gives us an 8.14% return. So if the company wants 8% return on investment, this one is going to pay 8.14, and they would say, yes, this is a good investment. Problem number 12. This is pretty straightforward. We're just looking for the internal rate of return or the yield. So we're solving for I. And the problem says if there's an investment out there that is going to cost $75,000, that we would pay $75,000 today, and it's going to pay us cash flow of $1,000 per month for 25 years. 25 times 12 is 300 months. What's the IRR on that? There's no mention of any final cash flow outside of the $1,000 monthly payment. So in this case, we would want to know that for our $75,000 investment, if we were getting effectively $12,000 per year, what does that work out to be? Solving for I. And in this case, it's important to note when you're solving for I, what you're going to get back is the periodic return on investment. 3.12. Now, it's important to know when you're punching this into the calculator that you're going to get the periodic return. So let's see what this looks like. 75,000. Change sign, because it's negative, it's cash out of pocket. That's our present value. It's going to pay us $1,000 per month every month. So that's our payment. There's no additional future cash flow. And it's a 25-year investment. So 25 and then hit G, N automatically multiplies it by 12. And then solving for I gives us 1.31. But remember, that is a 1.31 per month. So whenever you're solving for I, if you had monthly compounding, then the last thing you have to do, that extra step, is multiply it by 12. So when you solve for this, you're going to get 1.31. But remember, that's the periodic rate. That's times 300. So you got to multiply that times 12, and you get a final answer of 15.67%. So the second parts of question 12 are pretty simple. And it just says how much total cash is being received on the investment. Well, we know that. We get 300 payments of $100,000. So that's $300,000. That's the total cash. We paid $75,000. So $75,000 would be return of capital. And then $225,000. The rest of that being $225,000 is considered interest earned or profit. It's another one of these, we want to know how much it's worth today or how much we should pay for the investment today, but it's going to give us different returns each year. So again, we're going to treat this one similarly as 4 different investments with different timelines, and then we're going to aggregate the present value to know how much that investment is worth paying for today. So in this case, we've got the first year, after year 1, it's going to pay us a future value of $5,500. And then after year 2, it's going to pay us $7,500. After year 3, it's going to pay us $9,500. And then after year 4, it's going to pay us $12,500. In this case, we want to get a 12% return compounded annually. So we want to know what is the present value of each of those investments, and then we're going to add them up. So if we punch this into our calculator, and remember the future value is positive because it's going to be cash into our pocket, and the present value is going to be negative because it'll be cash out, and then we'll aggregate them. The first year investment, if it was by itself, would be worth $49.11 today. The second one would be worth $59.79 today. The third one would be worth $67.62 today. And then the fourth one would be worth $79.44 today. If we add all of those up, we get a value today of $25,596. Now, the second part of this question asks, well, what if that required return was monthly compounding? And then what would each of these investments be worth at that point? So let's take a look. So continuing with problem 13, if this same problem was monthly compounding, then there would be 12 periods in the first year, 24 periods in the second year, 36 and 48 respectively. And because we want a 12% return annually, we would divide that by 12, so it would just be 1% per month. So we would have 1% as our periodic required return. Again, no entering cash flows, so our payments are going to be zero. And solving for present value, we would get $48.81, and we would get $59.07 on the second one, $66.39 for the third one, and then $77.53. Adding all of those up, if we required monthly compounding instead of annual compounding, this investment would be worth $25,180. And the reason those two are different is just because of how often you're earning interest on interest, or in this case, what would be a $25,000 investment needs to compound at 1% per month rather than just 12% per year. Question 14. Okay, so in this particular case, if you haven't figured this out already, this is a trick question. And if you don't know why, pause it, go read it again, and see if you can figure it out. All right, here we go. So in this case, we have an investment for which we're going to pay $100,000, and in return, we're going to get $1,600 a month. We want to know over the span of 5 years, what is that internal rate of return? Now, here's where this is tricky. And if the internal rate of return is compounded annually, but we're getting monthly payments, and we can't use monthly periods. We have to use annual periods. So getting monthly payments really doesn't matter. So what we have to do in this case is we have a 5-year investment, and we are going to pay $100,000 for it. We're going to get our $100,000 back at the end, but we're going to get $1,600 each month. But it's only a 5-year with annual compounding. So what we got to do is multiply that by 5, and that means we're going to have $19,200. We're going to have 5 annual payments of $19,200, and then we're going to get our $100,000 back. That's why it's a trick question. If you look at this too, you can tell exactly what your return is going to be because it's a nice round number. We're going to have, if you solve for I, you're going to have 19.2% return. $100,000, every year you get $19,200 back, and then you get your $100,000 back. There's no change in principal. You're making 19.2% each year. This is question number 15. This one can be a little scary just because it uses some terms you may not have heard, like sinking fund. All this says is that we are going to need $60,000 at the end of 10 years, and we need to know how much we need to save every year to make sure that we have $60,000 at the end of the 10 years. So we know that is our future value is $60,000. And it's a 10-year deal. And we know that we're going to make 10% per year on our sinking fund, which just means that our savings account that we are putting money into to hopefully have $60,000 at the end. So if we're making annual payments, then we have to make 10 payments over the 10 years, and there's no mention of any starting point. So we don't have any money in the account already. And so if we just do 60,000 as our future value, 10 is our I, and 10 is our N, then we need to be making $37.65 per year into our sinking fund. And that will give us $60,000 at the end. And the question goes on to ask, well, what if we were getting that same deal, but it was, instead of annual compounding, it was monthly compounding? So we just multiply the N by 12 because it's monthly. So we'd have 120 payments. And now we want to know what our monthly payments are going to be. We still end up with 60,000. And at this point now, we're going to be getting 10%, but it's monthly compounding. So we're going to divide that by 12. Again, no mention of any sort of present value or initial deposit. So if we solve for payment here, it's going to be $292.90. Problem 16 asks us if an investor is looking at different investments that have different compounding intervals, what is the equivalent interest rate that they need to get the same yield? So the first investment the investor is looking at is going to pay 12% annually. So you can use any investment amount that you want, but I find that using $100, if you're just comparing interest rates, using $100 makes it easy because you can tell if I say, hey, you're going to make 12% on this $100, you know that that's going to be $12. But I'll show you how you do it on the calculator. So imagine that you have a 1-year investment, annual compounding, and you've got an interest rate of 12%. If you put $100 into it with no payments along the way, you know that you're going to get $112 out. You can plug that into your calculator, and that's what you're going to get. Now, if you wanted to make $12 on your investment and you knew that you were going to get monthly compounding, then all you would do is just go backwards. You still want to make $12, but now you're going to have 12 compounding periods, and you're going to put in $100. You're going to get $112 out. So when you already have this in your calculator, just leave these inputs in there. Just change the compounding period to 12 and then solve for I. And when you do that, you're going to get 0.95, and that's your monthly rate. So then just take that, multiply it by 12, and you will get 11.39. The next part of the question says, well, what if there was an investment that was quarterly compounding? Same thing. You know that you want to make 12%. And if you got quarterly compounding, what interest rate would you need to get an equivalent yield? So same thing, you would just take your inputs, you'd have $100 in, $112 out. You would change this to 4. In that case, you would get 2.87. Multiply that by 4 because that's the quarterly rate, and you would get 11.49. Now, frequently, what's going to happen when you're looking at real estate or other investments is you'll have monthly compounding, and you want to know what your internal rate of return is, or your effective annual interest rate, or your effective yield. So a lot of times what's going to be happening is we're going to be going backwards. You're going to have a monthly compounding scenario, and you're going to want to find out what is my IRR, or what is my yield. And what you do in that case is you just do the same thing, but in reverse. So you would take this and change whatever your compounding is to 1. So if you want to know what your annual IRR is, change your compounding periods to 1 and then solve for I. So in this case, you would do that. You would get 112 here. And then when you solve, you would get 12. So anytime you need to know your IRR or your effective yield, just take your scenario and change your compounding periods to annual. Problem 17 is exactly what we just talked about in problem 16, which is a monthly compounding scenario that we want to determine what is the effective annual rate, or the IRR, put in annual terms. So in this case, we have an investment that is 28 months long, and we pay $24,000 for it. Remember, that's negative because it's cash out of pocket. The investment returns $1,200 every month for 28 months. There's no mention of any future value cash flow at the end. And we can determine our monthly compounding rate, but what we want to know is, how do we report that in annual terms? So solving for this, we would get, for the monthly rate, 2.49. And anytime you want to just, again, take that and put it into annual terms, in this case, you can just multiply by 12, and you will get 29.83%. Now remember, that is the effective annual rate with monthly compounding. So what the question is asking is, what would the rate need to be in annual compounding to give that same return? If you just need to know what's the equivalent interest rate with annual compounding that you need to match this, just use that $100 example again. So if we said, hey, this is going to be, remember, this is monthly, so this is monthly compounding, and we're going to start with that rate. And remember, you need to put the monthly rate back in there. And we're going to invest $100. We're going to determine what our yield would be after 1 year. So you can either work backwards with your calculator and put this 29.83 and then divide it by 12 to get your monthly rate back in there, and then use a $100 investment. When you solve, you're going to get 134.27. And because we did it just $100, we can tell that we're going to make $34.27. But if you wanted to go back, you could then change your compounding periods to 1. You have $100. You get 134.27 out, and then you would solve for I, and you would find that you got a 34.27% IRR, or annual compounding equivalent.